income tax. So there are two sets of people. There are the accountants, the chartered accountants, the accountants, and there are the tax authority people. I mean, tax accountants and the tax accountant and the tax authority people. You see these people, these are accountants, very brilliant people. They are the chartered accountants, all those ACCAs, FCAs, ACCAs, CPAs, and so on. While the tax authority and the CIT, all those government officials, all those government officials. So when you see these people, when they come, they help you prepare your books. They prepare your books, and they prepare the tax computation, While these people, are we together, everybody? Yeah. These people are the tax authority. So what they do is, when they come for tax, so that's FIRS, LRS, they will now recompute what the tax accountant has done. This accountant, what it has done. So normally, they should have the same figure. Are we together? They should have the same figure. But in every case, they don't usually have the same figure. Are we together? No, we're glad we're together. Because when this person is preparing his books, it uses straight line method. While this person uses accelerated method. Are we together? This person uses straight line method, while this person uses accelerated method. Are we together? This person uses accrual concepts. Remember when we were doing accrual concepts, that matching principle. Why this person bases it on cash paid. So if the person does not receive cash, it will not recognize it in its books. So that's it. So those are the things that need to be different. These are the things that need to be different. So the tax accountant, if you notice a financial statement, there are usually two tax. There is the income tax, and the tax payable. Income tax 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 and the tax payable. So this one is in the P&L, and this one is in the balance sheets. Are we together? So let's look at it. Let's write. So we have a deferred tax liability. Let's write. When the income tax, the P&L, is temporarily greater than the income tax. That's right. Deferred tax liability. We have the deferred tax liability when the income tax is temporarily greater than the income tax paid. Income tax is temporarily greater than the income tax paid. We have the deferred tax liability when the income tax expense is temporarily greater than the deferred income tax paid. So the reason why this might occur, that's right, the reason why it might occur is because of all these things that are listed. So which is, when the revenue recognized on the income statement, before it is included on the tax return. before it is included on the tax return. Or when expenses are tax deductible, that's right, when expenses are tax deductible, when expenses are tax deductible, before being recognized on the income statement. Before being recognized on the income statement. So like I said, when the income tax expense is greater than the income tax payable, what do we have? What do we have? When the income tax expense is greater than the income tax payable, what do we have? Deferred tax liability. Thank you. Thank you. So, if for instance now, our deferred tax expense in 2021 is 10, and our deferred tax payable is maybe 4. What do we have as our deferred tax liability? Oh yeah, talk to me now. What is our deferred tax liability? 6. So let's say in 2022, this thing now reverse, have you? This thing reverse and say in income tax expense is 10, and our income tax payable is now 16. What do we have here? Oh yeah, talk to me now. Somebody say minus 6. Eh? 10. Somebody said 10, somebody said 0, somebody said 6.
Minus 6.
Minus 6, okay. What did you do? 0. Thank you. It's just like the where nominated for Minister of Finance. 0. Because there's no way you can recover your money back from the government. Any money you have paid back from the government, you can never recover it back. So subsequent year, you don't jump from deferred tax liability to deferred tax assets. You understand? So at this year, if you just be 0. Government tell them, okay, we are owing you, but you can maybe don't pay, but we will not refund the money you are owing us back. You understand? So if you say any question like that, next year will be what? 0. So let's go. Deferred tax asset, let's write. Deferred tax asset. Deferred tax asset. This is when tax payable. This is when tax payable. This is when tax payable is temporarily higher than the income tax expense. This is when tax payable is temporarily higher than the income tax expense. This is when tax payable is temporarily higher than the income tax expense. Tax payable is temporarily higher than the income tax expense.
So the income tax payable is what the tax accountants
Yes. Yeah. That's why the income tax expense is one what the
accountant.
when the income tax payable is temporary. So for instance, now let's say the income tax payable is greater than what? The income tax expense, I think. Income tax expense. Income tax expense, I mean. So what does it give us? Deferred tax asset. I mean, deferred tax asset. So let's say that one is what? This one is 28 and this one is 20. I mean, so what do we have here as our year 2021? Oh yeah. Talk to me now. What do we have here in 2021? When you have your income tax payable temporarily greater than your income tax expense, what do you have in 2021? 8. Thank you. In 2022, this thing now reverse, right? This is now reversed now to be 12 and 20. So what do we now have in your 2020? Your 2022. Yeah. Are you a bit confused? What do you have?
8.
0. Still 0. Cannot remember, always remember the subsequent year, you can never recover money back from the government. Understand? Makes sense, right?